Hello, and welcome to the Bull and Bear Invest channel's online learning series called Understanding the Stock Market. This is module 3.1, and we're going to be discussing technical analysis. By the end of this video, we hope that you gain a greater understanding in what technical analysis is, how to identify the most common share chart patterns, and how to use them to your advantage. Firstly, technical analysis is the study of financial markets based on the price movements over a set period of time. It uses a theory that the share price reflects all information about the share, including demand as well as its supposed market value. The term charting refers to technical analysis that is performed through the examination of the share price and its historical data to identify known patterns to predict future possibilities. Before we start, let's understand the basics. Support and resistance. Support is a price level where a downward trend can be expected to pause due to demand or buying interest. As the price drops, demand for the shares increases, thus forming a support line. Meanwhile, resistance levels arise due to selling interest when the prices increase. Once an area of support or resistance has been identified, those price levels can serve as a potential entry or exit point because as a price reaches a point of support or resistance, it will do one of two things: bounce back away from the support or resistance level, or violate the price level and continue its direction until it has hit the next level of support or resistance. The timing of some trades is based on the belief that the support or resistance levels will not be broken. Whether the price is halted by the support or the resistance level, or it breaks through, traders can predict the direction and can quickly determine if they are correct. If the price moves in the wrong direction, the position can be closed with a small loss. However, if the price moves in the right direction, the rewards could be substantial. Trend lines. Trend lines are recognizable lines or curves that traders draw on charts to connect a series of prices together. The result is then used to give the trader a fair indication of the direction in which the value of an investment might move. Trend lines can be applied to the high and low prices to indicate a channel. A trend line is a line drawn over a series of highs or a series of lows to show the prevailing direction of the price. The trend line provides a visual representation of the support and resistance in any given time frame. They show direction and speed of price variation and also describe patterns during periods of price consolidation. The trend line is among the most important tools to conduct technical analysis. Instead of looking at past business performance or other fundamentals, technical analysis allows you to identify trends in the price action to determine the current direction of the market price. To create a trend line, you must have at least two data points on a price chart over your chosen time period. Trend lines are relatively easy to use. You simply have to chart the price data normally using open, close, high and low. More than one trend line can be applied to a chart. You can use a trend line connecting highs for a period as well as connecting lows in order to create the channel. A channel adds visual representation to both the support and resistance of the time period being analysed. Similar to a single trend line, you are looking for a spike or a breakout to take the price action out of the channel. You can use this as a way in or a way out depending on your strategy. Trend lines have to be readjusted as new data becomes available, but a trend line can last for a long time as well. Eventually, however, the price action will deviate enough that it needs to be updated. To identify the trending pattern of the peaks on this share chart, draw a line from all three peaks that we can see. The line is evidence to suggest that the price is moving in the right direction. We can confirm this by linking up all the low points on this graph. Again, we can see that the price is showing a positive aspect. By placing the high and the low trend lines on the chart, we provide ourselves with a price channel. A price channel appears on a chart when a share price becomes confined between two parallel lines, buffeted by supply and demand. Depending on the direction of the trend, the channel may be horizontal for a steady price, ascending for a rising share price, or descending representing a decreasing share price trend. Price channels are quite useful in identifying breakouts, which is when a security's price breaches either the upper or lower channel trend line. Traders can sell when the price approaches the prices channel's upper trend line and buy the stock when it tests its lower trend line. The lower trend line is drawn when the price moves higher, while the upper trend line is drawn when the price moves lower. The steepness of the inclines and declines determine the direction of the price channel's trend. The two lines of a price channel represent the support and resistance. As you can see in the example, we have quite a clear price channel. Let's take a look at what can happen when the price breaks out of this price channel. As you can see, a breakout can be an incredibly profitable scenario. What is a continuation pattern? Well, a continuation pattern is an indication that the price will continue to move in the same direction as the pattern completes. There are several continuation patterns that you can use to identify that the price may continue to trend. These include triangles, flags, pennants, and rectangle patterns. Not all continuation patterns will result in a continuation of the trend though. For example, the price may reverse the trend after forming the triangle or pennant. Continuation patterns are most reliable when the trend moving into the pattern is strong and the continuation pattern is smaller than the trending waves. If the continuation pattern is almost as big as the trending waves that preceded, suggests increased volatility, a lack of continuation in the trending direction, and larger moves against the trend, all of which are warning signs. Smaller trending waves that are followed by a continuation pattern can prove troublesome. If the price grows a little and then forms a continuation pattern before repeating itself, this is less reliable than a strong move higher that then forms a continuation pattern. The most common trading technique is to wait for the pattern to form, draw trend lines around the pattern, and then enter a trade where the price breaks out of the pattern into the direction of a normal trend. There are steps involved in trading a continuation pattern. Firstly, recognize the prior trend direction. For example, was the price increasing or decreasing before it forms a triangle? Then recognize the continuation pattern and find the breakout point. Upon a breakout, a trade is taken in the breakout direction. A stop loss is placed just outside the pattern on the opposite side of the breakout. A profit target can be calculated based on the height of the continuation pattern by subtracting the support price from the resistance price. If it breaks downward, then subtract the value from the support price. If it breaks out into an upward trend, then add this value to the resistance. The drawback to trading continuation patterns is false breakouts. A false breakout occurs when the price moves outside of the pattern but then moves back inside it or out the other side. Look for increase in volume when the price breaks out. If there is little volume on a breakout, there is likelihood the breakout will fail. Triangles are arguably the most reliable pattern of all, and they are formed between converging support and resistance lines, and the momentum generally continues in the direction of the slope at the time of the breakout. An ascending triangle is formed with a horizontal resistance line with a sloping support line, and descending is the opposite with a horizontal support line with a sloping resistance line. A positive sloping suggests an increase in profit, whilst a negative sloping suggests a reduction of profit and uncertainty of stock. Here we will explain how to identify an ascending triangle and how to use it to predict the breakout point and the estimated share price thereafter. We have used a share chart from tertiary minerals in this example, and we can see two very obvious triangles but of very different shapes. The first started in November, but can be seen more easily as December draws to a close. We can see that the resistance line is in the margin of 0.274. This will form the horizontal line in our triangle. Now we use the trend line of the support, and we can form the lower portion of our triangle. The breakout is evidently clear, and a healthy price was provided by a large volume of shares being purchased. But what if we could predict how high the share price would go upon a breakout? Well, it's not a foolproof technique, but there is a way to estimate this value. If you take the value of the resistance level, minus the value of the lower peak of the triangle, then add this value to the resistance line once again, this gives you an estimated profit. Or for a less mathematical approach, rotate your triangle 180 degrees, keeping the resistance lines together. The height of the new triangle acts as your share price estimate. As you can see, it's nearly a perfect match. To test this works, let's try a second triangle on this chart. This triangle is formed over a shorter period of time in February. Similarly to before, mark your resistance line with the upward trend line, spin your triangle 180 degrees, And there's your estimate, almost lining up perfectly once again to the closing price following the breakout. It's important to remember that this is only an indication of the share price. It could fall short or exceed the estimate massively. Either way, it's a good method to use to spot opportunities to make some money. As breakouts can occur in either direction, it may be worth setting a stop loss just below the value of the breakout, or the tip of the triangle. Just be reasonable, as you don't want the stop loss to be triggered as the price readies for the breakout. Flags are common patterns that occur when share prices consolidate. When the price breaks out of these patterns, the price is likely to continue on the same trend as before. They are formed when the share price rises from the support level to the resistance level. This is called the flagpole. The pullback action creates a diagonal price channel that should be no more than 50% of the initial upward movement. As the share price breaks the price channel, look for a higher than normal volume of buys to confirm that the price is likely to continue upwards. You can use the length of the flagpole to calculate the share price projection by placing it on the tip of the flag. This will give you an indication to what to expect the share price to rise to. You should also consider setting a stop loss underneath the flag to prevent any losses should the trend not continue in the upward direction. The cup and handle pattern is a downward trend from an initial peak value followed by a period of consolidation before it continues with its upward direction matching the initial high point forming the cup. The share price is then expected to bounce about in a narrow but stable price channel or a triangle forming the handle of the cup. To trade with a cup and handle pattern, it is ideal to set a stop loss directly underneath the handle of the cup. A well-placed stop loss on a formation such as this can prevent any unnecessary losses and allow maximum rewards. You can predict a price projection of the share price by taking the lowest point of the cup and the highest point of the handle and measuring the distance. Add this price to the top price in the handle and you've got your projected value. We understand that there's a variety of other patterns available. However, we also believe that these are variations of the three of which we've already described. If you can understand the fundamental principles of identifying patterns and how to use them to your advantage, then this is the best foothold you can have to start your investment career. If you would like to see a video on another sector of the stock market, please do let us know in the comments below. The sole intention of the Bull and Bear Invest channel is to simplify the investment processes, to help you make the most of your money. The information within this video is not financial advice and you should conduct your own research at all times. If you found the content of this video useful, don't forget to subscribe to our YouTube channel, the Bull and Bear Invest channel. We've also included a referral link to Freetrade in the description of the video below. If you sign up and make a deposit using the referral link below, you can start your portfolio off with a free share courtesy of Freetrade. Remember, your capital is at risk when investing. Share prices can go down as well as up, so only invest what you can afford to lose.